This podcast may contain paid advertisements, but more on that later. Welcome to the O'Connor Bootstrap podcast, where I discuss the nuts and bolts of business and leadership, with a focus on bootstrapping a business from the ground up. This podcast is for all entrepreneurs, bootstrappers, and leaders in all walks of life. My goal is to help you grow both personally and professionally. I am your host, Isaiah O'Connor. Today's podcast is brought to you by Audible.com. I love Audible. I always talk about Audible because it is my favorite app for listening to books, and listening to books is the only way I get to read these days, and reading is so important. It's the best way to learn and grow your business, grow yourself personally. Definitely highly recommend Audible. Today, the book I'm recommending is again The Total Money Makeover by Dave Ramsey. I learned so much from this book and from his course, Financial Peace University, which brings in the Total Money Makeover with it. But if you want a good book to get you started on a good financial footing for you and your family, I highly recommend The Total Money Makeover by Dave Ramsey. It can be a life changer. He covers everything in that book, all the basics of finance, how to get out of debt, how to start investing, how to just deal with your money. It's a really great book. Go check it out. The Total Money Makeover by Dave Ramsey on audible.com. And of course, you can get a free copy when you use my code Bootstrap. That's audible.com/bootstrap with a capital B. You use that code, you can go in, sign up, get a free 30-day trial. You get one free Audible book, Total Money Makeover, great book. You get 2 Audible originals that you can keep forever, and then you also get to listen to their entire listening library, their streaming library, for the entire month. So very, very cool. Go check it out. After that, it's only $14.95 a month afterwards. You can cancel at any time, and you keep any of the books you've gotten. The books. You lose access to the streaming, but any books and Audible originals you download, you keep forever. You can always go back. Another thing is, you can go get, for example, The Great Courses is on Audible, and you can actually get the PDF files that go with the courses. Also there, also forever. Really, really useful. I love it. Go check it out, audible.com/bootstrap with a capital B. Helps me out as well, so go check it out. Thank you. Now, today I'm going to be talking about mutual funds. This lesson was inspired by Dave Ramsey and the Financial Peace University, which again, this is not a paid promotion for Dave Ramsey Financial Peace University. It just is a great program, very well worth the money. It can help you get out of debt. It can help you deal with money with your spouse better. It can help you learn about investments, about things like insurances. He covers everything. It's 13 courses, completely free shout out. I think it's an amazing course. Go check it out. But in that course, I learned the basics of mutual funds, and I'm going to add a little bit. So this comes a lot from that, but then we'll throw in some other details. Now, so let's talk about mutual funds. What is a mutual fund? So first, as I've explained what a stock is a part ownership in a company. And a mutual fund is people mutually pulling their money to buy something, stocks, bonds, etc., in together. So you mutually fund purchases of stocks and bonds and other financial instruments. I've seen some you can buy CDs, not music discs, but certificate of deposits. You can buy different things. Now, a mutual fund is, say you got just basically 10 people, they all throw $100 in, and now you have $1,000 that you can use to go buy stocks, and you put them in. So that's a basic idea of a mutual fund. You mutually fund the purchase of stocks, bonds, etc. Now, as a side note, what is a bond? A bond is a debt instrument. A bond is a company issues a bond, or the government, which they're borrowing money from you. You buy the bond, and when the bond time comes up, they pay you back your money that they borrowed from you plus interest. That's a bond. It's basically a way to borrow money from people for your company, and then you have to pay back the money. If you're in the company, you pay back the money to the people that hold the bond plus interest, and that's where they make their money on the bonds. Government issues bonds more often than other companies that I know of. But yeah, that's why you hear a savings bond, US savings bond. It's the US government borrowing money from you and then paying you back interest after a set amount of time, paying you back the initial amount they borrowed. Say that it was a $10 bond, you buy $10, you pay $10, they pay you back your $10 plus interest, say another $5 or whatever. So that's how the bonds work. So a mutual fund is a whole bunch of people getting together and buying stocks and bonds and other investments within the fund. Now, these funds are managed by a mutual fund manager, or better, a team of managers that their full-time job is to decide what to buy and sell. And they usually sit within a certain type of mutual fund where they're buying and selling this type of mutual fund. It might be just bonds, a bond mutual fund. There's multiple different types. I've just a quick research. I've seen 4 types. I've seen 7 types. There's multiple subtypes. For example, there are definitely very specialized mutual funds. For example, I've seen one that is a mutual fund that only invests in green energy. And that's it, or green products, green stores, green energy, and that's the only type of funds they buy. They buy just one sector of one market. So that's what they do. But basically the idea is this, though, that whatever they buy, whatever types of funds they buy, they have a team of managers that decide what they're going to buy and sell, and that's their full-time job. And then these teams of managers, they also have what are called stock analysts. Now, these stock analysts are really expensive nerds, as Dave Ramsey says. They're a very specialized person that understand an entire field of their research, and they're super intense. They understand things. For example, you might have a restaurant stock analyst, and this stock analyst knows the restaurant business, worked in restaurants, perhaps has owned a restaurant, been a CEO or CFO of a restaurant. They understand how to run a restaurant. They've been in the industry for years and decades. They know the restaurant industry. They know what people want. They understand restaurants very, very well. They go to all the restaurant trade shows. They travel around, talk to people in restaurants. They know things about restaurants. They're following the trends. They're following everything, all the ups and downs in the restaurants. And they pay attention to what's going on in the restaurant world. And when something happens, a big change, then they can call the managers and say, hey, this is the trends or what's going on, buy or sell. For example, they can say, hey, we've heard that such and such a restaurant, they've gotten some contamination in their food supply. We just heard about it. It's probably going to hit the newspapers in the next couple of days. Their stock's going to tank. Sell. Or on the flip side, they'll say, hey, such and such restaurant chain is about to open 4 more stores to great fanfare, and they're expanding. We heard this in the trade show that they're going to start opening these stores, and their stock's going up. Buy. So these guys are very well paid people that focus on one sector of the economy that they're super good at. You can have a guy who just follows everything Apple, guy who follows everything electronics, smartphone guy, computer guy. a farm guy, every branch of industry, an oil guy who follows oil and the gas industry, the energy. All these guys are called stock analysts. They focus on one sector of the industry, and they relay information that they find to your mutual fund managers so they know what to buy and what to sell. And they really work together with these guys. And no, this is not insider trading. This is basically paid research so they can decide. So that really helps them be able to choose and grow and manage these funds so they keep making money. This is part of the reason why if you hold on to a mutual fund for at least 10 years, a growth stock mutual fund, to be specific, 10 years, not all mutual funds do, 10 years, they will make money because these guys are managing it very, very well because they have a lot of data at their hands. This is why a mutual fund company can usually manage stocks better than a person can individually because a person can do all the research, but they may not have all that the ability to research thousands of companies and keep up with all these different companies, all these different changes, because as a single individual person, you may not understand all the details about every industry that you're buying stock in. These mutual funds, they do. They don't know it personally, but they have all these other people specialized that they're paying thousands of dollars, tens of thousands of dollars. These guys make maybe 70, 80, 100, $200,000 a year, these stock analysts, to do this. So these are highly paid researchers. They're very, very good at what they do. And that's why mutual funds can do better than a private individual investing because they have all this extra research going on. Now, we have these mutual funds, and I'm going to focus on the four that I think are the best ones to look at. These are the four that Dave Ramsey suggests to go into. I'm going to explain those a little bit. And these are growth stocking. They're called growth stock funds, growth mutual funds. I gotta go read that up. So they're growth and income, growth, aggressive growth, and international funds. Okay. So I'll go into each of those. So a growth and income fund are funds that are in companies that are really, really large companies. They can be called growth and income stocks. They can be called large cap funds or large value. You may hear them called blue chip funds, dividend, or equity income funds. So a lot of these funds have a lot of different names, but by large cap, they mean large capitalization. These are big companies, monster companies. These are Apple, IBM, AT&T. These are massive, slow-growing companies, but they're just massive, big companies that have been around forever and will likely be around for a long time. They're not growing very much, but they are big, they're solid, they have a lot of money, they don't fluctuate much, and they're nice because when you invest in these companies, it's not exciting, they're kind of boring. They don't usually bring you a huge growth in your investments, but they're very steady. They grow very slowly, they're not going up and down, but they do just kind of keep growing very steadily. They don't go down a lot, they go up more than down. They're just very steady. But slowly, they're not going to get a huge rate of return, but they're nice because they're good, solid companies. Then you have growth funds. And this is medium or large companies, US companies, that are growing. And this is from the Dave Ramsey website. Unlike growth and income funds, they're more likely to ebb and flow with the economy. So you might be able to find a company that makes the most coolest gadget or luxury item in your growth mix. Common labels for this category are mid-cap, middle capitalization, equity, or growth funds. So these go up and down a little bit more. They will flow closer to what's going on in the economy. Stock market goes up, these will go up. Stock market goes down, these will go down. And then you have aggressive growth. And these are the what's the word I'm looking for? These are the crazy funds. They're really exciting. They go really up, they go really down. They're a little bit bipolar. They're either really, really up or really, really down. They're kind of not usually in the middle. And they're called mid or small cap funds. There's middle size or small companies. These are like the good old tech stocks. A new tech company shows up, you invest, and hopefully it goes way up, goes big. So you might have invested in MySpace initially, but then Facebook took over, and then back and forth. These are really exciting funds. They can make you a lot of money really quickly. They can lose you a lot of money really quickly. But it's back and forth. And again, these are all things you do to hold on to. With mutual funds are not a get rich quick scheme, by the way, while I'm thinking about it. These are things you invest in and then leave. You don't touch it. And then you have international funds. These are funds that are located outside the US. And some of these are companies that you don't even realize may be international. Trader Joe's, Firestone, Gerber, different Toyota, different cars. There's a lot of companies that are in the US that you're used to, and you don't realize that they're outside of the US. They're owned by outside. And that's not confused with world or global funds, which includes the United States and foreign stocks together. But international funds are funds that are only based in companies that are outside of the US. And these funds are good because they're not necessarily tied to what's going on in the US. So that's pretty cool. You can invest. Now, another great thing is if you invest in mutual funds, every fund you invest in is going to be probably around 1,000 plus in stocks. So it's a great way to really spread out your money with a very limited amount of, if you have a limited amount of money, you can really spread it out amongst lots and lots of stocks. And you put them in, you invest it, and you hold on to it for a long time. These are funds that you don't mess with. You buy them when they're low, and then don't touch them. And you can make money off of funds. You will get returns, dividends, etc. off of these funds as well. But you can just leave them and hang on to them. You can buy them 10, 15 years later, take a look at them, and they've gone up, and then you'll be happy. So you don't touch them. And again, mutual funds go up, they go down, like all other stocks. But it's kind of like gas prices. The gas price goes up, and then it goes down, and then it goes up and goes down. But over time, the gas price always winds up higher than it was. For example, I remember when gas prices were under $1, and people were freaking out when it went over $1, and now it's over $2 a gallon. $1.50, $2 a gallon, something like that. I don't know. So gas prices go up, they go down, they go up, they go down, they go up, but they eventually wind up higher than they were before. Same with mutual funds, but the trick is you got to hold on to them. If they go down, don't panic. Matter of fact, I know one guy that in 2008, with the whole stock market crash and everything else, he panicked and he sold off all his funds because he saw them losing money, and he sold them off on the way down, and he lost most of his retirement because he sold them when they were going down. If he had not panicked and just held on to them, they would have bounced back and he would have been fine. But he panicked and sold them. So these are things that you just buy them and forget them. You don't worry about them. Yeah, sure, you can keep track of them, watch them, but they go up and down with the market to a degree, but they always wind up higher. But you have to sit back, hold on to them, and relax. Just chill. Just buy them, forget them, let them grow. don't panic. And these are great for retirement savings. These are great for long-term investment for your business. So these are things you just sit there and wait on. And so that's mutual funds. Not much more I can say about them. If you want to know more about mutual funds, this again, go take a look. Go look at Dave Ramsey's website. He talks about mutual funds. He talks about the best way to buy them. His suggestion of how to buy them. He has professionals that can help you invest. Now, remember, I'm just an amateur with this. I just have a basic understanding of the market. So this is just what it is. How to invest, what to invest in. You should go talk to a professional. Again, I highly recommend Dave Ramsey's website. Again, this is not a promotion, not paid. But if you want to invest, you can go to Dave Ramsey. He has people that he recommends for investments, and they will help you through the investments. And I've used his people to look into investments, to look into insurance. He has all these people, and they have always been amazing. They've helped me out. I highly recommend it. Again, this is not a paid promotion, just I've been very happy with this result. Go check him out. DaveRamsey.com. Look up mutual funds, look up investments. Great place to start to get yourself on a good financial footing for yourself and your business. And perhaps I will talk about one of his books in the next podcast or two. So talk to you later. Bye-bye. If you found value in this content, please leave a comment and give us a 5-star rating on whichever podcast platform you use. We are on Apple Podcasts, Spotify, Google Podcasts, and most other podcast platforms. If you would like to support us, you can check out our sponsor links, or if you would like to directly support the show, you can donate or join our membership program at buymeacoffee.com/bootstrap. Of course, it really helps when you share these podcasts as well. If you would like to interact with me and other bootstrappers and leaders, you can join our O'Connor Bootstrap Podcast Facebook group. You have been listening to the O'Connor Bootstrap Podcast and Atheoz Business Solutions Podcast. For our companion podcast, the Atheoz Business Podcast, hosted by Jason St. Clair, past episodes, and related blogs, check out our website at www.atheoz.com, which is www.atheoz.com, or theoz.com. Until next time, I've been your friendly neighborhood entrepreneur, Isaiah O'Connor.